Thank you everybody for coming. A big focus of what we're going to be talking about today is our look ahead into 2020, and we'll try and share some of the concerns and thoughts we have and how that's kind of filtering through into how we're positioning within the different model portfolios. Just in terms of talking very, very briefly about performance up until the end of November, we've not changed very much, which can be interesting when you're sitting down talking to clients and justifying that they're still paying fees, you're still paying fees, we're not changing anything. But if we're comfortable with how we're positioned, we don't want to trade just for the sake of trading. So very different performance numbers because of some of the movements of the underlying bonds. Our focus is obviously still trying to hit the absolute return on a consecutive monthly basis and trying to build that up over the course of the year. Last month, we went through a lot of the performance data. This time, we're just kind of taking a quick snapshot at the month. When we stand back and look at the year, most of our models are, actually all of them are north of 10% for the year. We're running on an annualized volatility of between 4.5% to 6%. And a lot of this performance is sitting sort of 11 to 12% for the year. So we're quite happy with how we've had the portfolios positioned. We took a lot of the equity performance in the first half of the year. And since then, we've been sat very overweight fixed income. And we've been changing our duration strategies depending on the underlying currencies. But that's meant that what we've been trying to focus on is delivering these small components of absolute return on a monthly basis for a lot of our clients. So this is the bit where I get to hand across to Jeff, realizing that I've got the clicker and he's got the mic. So we'll do a very subtle pass across. Jeff is going to talk you through a little bit about fixed income looking forward, talking about how we're positioned and some of the concerns. Over to you, Jeff.
Thank you, Simon. We've got 6 key themes across that we're looking at for 2020. And I'm going to focus on the first 3 and how they shape our portfolio allocation and also how they will impact the fixed income markets. The first one is the risk of a slowdown and the need to hold core government bond positions. Secondly, we've got the prevailing low interest rate environment and negative yielding bonds and the need to reach into crossover or high yield rated instruments for the spread. And then thirdly, I'm going to speak about how we'd like to navigate climbing corporate leverage and avoid pockets of distress. Now, on the first theme of macroeconomics, we don't expect a recession next year. It's been something that a lot of investors have been focused on, especially after we saw an inversion in the US yield curve earlier this year. But with 3 mid-cycle rate adjustments by the Fed, I don't think it's very likely that there'll be a recession next year, given the accommodative monetary backdrop. But there are 2 weak spots that I'd just like to highlight. One is that we've seen 4 consecutive months now of weak manufacturing data printed by the ISM. And that has come below the expansionary level of 50. And this risks spilling over to the rest of the economy. And it can weigh down on both job growth and also capital expenditure. And although the labor market has been rock solid, we're seeing the purchase of durable goods also come down now. And in the event the economy does take a turn for the worse, the Fed now has a depleted toolkit should growth falter further. So for that reason, we're taking caution in investing in risk assets in the US. Now, the second point was on low interest rates. Now, what do you do when there's $17 trillion of negative yielding assets across the fixed income universe? We aren't interested in paying banks interest to lend to them, nor are we really that interested in earning a yield of under 1%. And our base case is that there won't be further monetary loosening next year, but there will be an accommodative backdrop, at least in the developed markets where they have very little headroom to reduce rates further. So in the euro-denominated universe, we, like Greece and Italy, 10-year paper. In Italy, the European Union has forced fiscal discipline upon the Italian government, where we don't think the spending or the budget deficit will exceed 3%. And in Greece, through fiscal reforms, including on tax collection, we think Greece is now on a sustainable path towards recovery. So for those two fundamental reasons, and due to the valuation levels and the more attractive yields, we prefer Greece and Italy in the sovereign universe. And going into 2020, our second favorite pick is European high yield. And this is for four reasons. One, there's the attractive value. You can see that the spread offered by high yield versus investment grade is actually above 3 times, and it's still above the average of the last 12 months too. So we still see value there. Secondly, the structural composition of European high yield, when we compare it to US high yield, there's a much lower exposure to energy and basic materials companies. In fact, it's just 10% of the total index in Europe versus over 25% in the US. And we have a negative outlook on both the energy sector and the basic materials sector going into next year. That's both due to continued geopolitical tensions and bubbling tensions in the oil producing nations, Iran and Saudi Arabia, and also due to slower global trade volumes. And then we also think that the ECB could provide a technical support for the high yield market where they could extend the asset purchase program to include the purchase of high yield bonds. And then last but not least, we think default rates will remain below 2%. We saw in the second half of this year a resurgence in debt refinancing, $2.4 trillion on a global basis. And that we think will put corporate balance sheets on a stronger footing and also materially improve the liquidity profiles of companies. And with our expectations that there will be choppy waters next year, we would rather maintain our flexibility and be able to trade in and out of our positions with relative ease. And for that reason, we prefer large liquid tranches of bonds or expressing our view on the market through the use of exchange traded funds. Now, the third point is on credit fundamentals. Now, debt leverage has only trended higher since the financial crisis. And that's been fueled by a combination of two factors. One, there's the lower interest rate environment, and two, 10 years of consecutive economic growth, positive growth that is, in the US and developed markets. More recently, the spike that you see, that's just due to a change in accounting standards where operating leases, that's rent, is now classified as debt since it's a long-term obligation. But you can see that the segment of this universe that's been feeding off debt for growth is the line at the top. It's the single B and triple C rated bonds where they've seen a material increase in leverage. Now, we've seen significant underperformance in both triple C bonds and energy bonds through 2019. And some investors may even say that they look cheap, but we take the view that energy bonds will still struggle, given that we've seen a lot of write-offs and impairments on E&P assets through the year. And also the basic material sectors will be impacted by this slowdown in global trade volume and this ongoing tit-for-tat negotiations, whatever you like to call it, between the US and China. But we still have a constructive view on credit. If we look at the chart on the right, that shows corporate investment plans are now sitting on the sidelines and beginning to stall. Now, the impetus to push expansion programs has been restrained by what I would describe as four factors. You've seen softer capacity utilization. There's also been flagging demand for durable goods purchases. We've got pressure and disruption on supply chains and higher material costs due to the potential for tariffs that are tied to Brexit between US and China, but also auto tariffs between the US and EU as well. And all of this overlaps with election uncertainties as we head into 2020. So for credit investors, we think this pullback in investment spending should actually be perceived positively. It should provide temporary respite, given that the conserved cash flow from not investing in expansionary programs, that cash flow could be used to and it could be deployed towards paying coupons, reducing debt, or just fortifying the balance sheets of companies. Now, I'd just like to segue onto one of the major projects that our quant team has been working on. And Dolfin are very proud to share with you our in-house bond screener tool, which will be available for clients from next year. Just to illustrate its capabilities, I've created one screenshot from the website where you can actually input any criteria you like: credit rating, currency, sector, seniority. It's very versatile in that nature. Here, I've got the universe of euro-denominated BB bonds. And that curve that's fitted through the middle shows you the average yield of that sector, which we deem fair value. And very easily, conveniently, and efficiently, you can see that SoftBank stands out as being cheap. And likewise, ball packaging is expensive. But that's something, if you reach out to your relationship manager or reach out to me, my details are available on this slide. We can walk you through how this can be used further. And then just finally, to provide an overview of our current positions and how we're heading into 2020. What does it mean for positioning? So in the US, we like government bonds, not just the 10-year, but even the 30-year. We think it's well supported. We saw issuers, including Kansas City Southern. They came out with 50-year paper 2 weeks ago. The BBB rated telco company Corning issued 60-year paper. So the corporates are paying attention and they're seeing comfort in issuing at the very longer end of the curve. And that's reflected in investor appetite and also our comfort in holding a longer duration position in US government bonds. In Europe, as I said, in the reach for yield or spread, we like high yield credit. And in the UK, our base case is that the Bank of England won't move on rates and take any action until at least the second quarter of 2020. And through the period until then, at least through the election campaign of the next week, we're taking a neutral stance on sterling assets. And just finally, there will be a downloadable version of this material on the Dolfin website very soon. And we will be providing details of all of our portfolio positioning and also our trigger positions on each of these positions with the catalyst that will be related to each of them.
Thanks, Jeff. Jeff's lucky because in his table, he's got a few green boxes. I'm almost exclusively on the equity side, amber and red. A lot of what we've got up here on the slides is obviously our current thinking, current positioning, and how we want to be for 2020. The thick magazine that was sitting on your chair is our current quarterly. We're in the process of writing the next one. What we've tried to do in the quarterly is to sort of peel back the lid and show you a little bit what's going on and what we're doing as a team from a process and structure perspective. So when we're talking about some of the positions that we're looking at, we show you how we started looking at the market, how we screen the market, how we analyze, how we actually come up with how we want to be positioned on the government yield curve, currency by currency. We start talking you through the data points that we're analyzing, and we actually are trying to take you on the journey so that you can actually understand how we've come to our current viewpoints and why we are positioned across the fixed income curves in the way that we are. That's one aspect of what we've got in the quarterly magazine, but we're going to now take a stroll through equities. So I'm going to try and hit on points 4 and 5 where we're looking at political risks over the next 12 months and also the trade tensions that we've been suffering almost for the entirety of 2019. When we sat down and came up with this list, almost everything there is multi-asset. And one of the nice things we have that we're running absolute return global multi-asset portfolios is we have the ability to pick and choose where we want to be invested and how we want to be invested. So when we're looking at trade tensions, not only is that going to feed through into how much equity exposure we have and where we have that equity exposure, but if we want equity exposure to begin with. We have the ability to move out of equities and move into the long section of the US Treasuries curve. This is part of the power of what we're trying to do and what we're trying to explain in the quarterly, why we're making decisions like that, rather than being very benchmark driven and being able to go slightly underweight equities if we think that there is a real pullback coming in equities, or we're concerned about valuation, investor sentiment is far too bullish, we think technical levels are not looking favorable, we can come out of equities. That's how we're currently positioned. That's why our annualized vol has been so low for the whole of 2019, because the back part of it, we've had very little equity exposure. We've dipped in and out, but the concept of sitting and holding a huge portion of your portfolio in equities, from our perspective, given some of the risks that currently exist, doesn't make sense for 2020. We would have a lot more volatility, and we're not necessarily going to be going in any strong direction. 2019 has been a really good, positive year for US equities, global equities. The concern for us is, how's that going to continue forward? What's the catalyst to push it forward? Even in 2019, we've been looking at Brexit negotiations, which feel like they've been going on for a decade. It's only 3 years, allegedly. Trade tensions in terms of what's happening between the US and China. How is that going to get resolved, and how quickly is it going to get resolved? And when we're looking at the trade tensions aspect, we come back from my perspective to the idea of patience. And Trump is determined to try and get a deal through, arguably needs to get some sort of deal through to try and spark his re-election campaign. From my perspective, both sides want a deal, both sides will need a deal, and it comes down to the game of chicken and who's able to wait longer. We have a belief in the way that we've set up our portfolios. This isn't finished yet. There's going to be positive and negative announcements from Trump's Twitter account, and the equity markets will react on the back of that. When we see range-bound equities, we don't see the point in taking exposure. This is the idea of what we try to do in our core satellite approach, in that we'll take equity exposure in the stocks that we want, that are in the sectors that we want, that are in the countries that we want. And this means that we can construct a portfolio as we have at the moment with no core equity exposure in it. We don't want to just sit and hold global equities for the sake of holding global equities, but we'll own stocks that we like. And that's how we've been constructing the portfolio, and that's how we currently sit. So this is my not particularly attractive chart. This is why we've got no core equities. It's strange when we start looking at some of our peers and we start looking at the concept of how they're managing money. And we come back to the idea of, if you don't like it, don't buy it. Yes, we're neutral on some areas, but neutral for some investment managers means I own the benchmark allocation. So if you're neutral UK equities, you own 7% of your equity in the UK, for example. Our rationale is, if we don't think that it's worth owning, if we don't think from macroeconomic data, Jeff picked out on a couple of aspects of macroeconomic data that we're a little concerned about. That has a negative feed-through impact on how much we're going to have exposed to equities. We are underweight across the board, which for us as an absolute return manager means we don't own anything. It's interesting from the perspective of watching some of the equity market volatility. Earlier this week, we had a couple of quite big down days, quite sharp adjustments in equities. And we sit there watching. Enjoyment is not the right word, but it has no impact on our portfolios. We're so far out of equities that we only have the specific stocks that we want to own. And that means that when we are getting the stock selection correct, and in the quarterly, we've tried to take you through how we go on that process and why that's different to a normal fundamental analysis of a stock, then we've got some really, really good performance from the underlying stocks that sit in the portfolio. So just to sort of, valuation is one of our key concerns as we head into 2020. We've seen a big move higher over the course of 2019. We've seen a rally in the last quarter, and that's been at the expense of ratios. So valuations are getting more stretched. We've seen earnings expectations continue to be dialed down, and the stock market continue to move higher. And that's not a sustainable pattern from our perspective. Even though the surprises were fairly standard, it was the growth or lack of that is concerning from our perspective. We've got full year 2020 expectations sitting at a little over 8%. We think that that's slowly going to dial down. When we look at this on a monthly basis and we start looking at what are expectations, you can see the S&P 500 has been reasonably flat when we're looking at an EPS perspective. Euro Stocks has been quite depressing, as has the emerging market, and the FTSE's taken a little bit of a pullback as well. But this is earnings expectations. When we were investing, we want to hold companies that have growing earnings. When we're looking at an index level, we're not seeing that. And this is why we're not owning the index and owning a little bit more on the individual stock side. And CAPE ratio. This is something that we look at normally when it gets to these sorts of levels, where we are on the cyclically adjusted price earnings ratio, taking 10 years worth of trailing earnings data. It's been higher than where it is now on 2 occasions. One was 99-2000, just before the tech bubble burst, and the other time was back in 1929. I don't think anyone here was around to see that. But one of the big issues here is the only way that that can come, well, there's 2 ways that we've moved down from here. Either there's a huge increase in revenue and a huge increase in company earnings over the next 12 to 18 months, which we don't see happening, or there's a correction in the stock price and the stock market pulls back a little bit. Now, from our perspective, if we see a bit of a pullback in the stock markets, that's when we'll look to try and take exposure. But right now, sitting where we are, we don't think that we're going to get enough bang for our buck. This was a chart that I thought was interesting, and this is not a prediction for how the market's going to look in 2020, or 2020, sorry. In 2008, it was a pretty horrible year for equities. And if we can extend that on either side and take it back to October, November 2007, wind it forward to March 2009, the same patterns exist, that when you stand back and look at the entire journey, it was a horrible negative 40-45% journey. But there were times in it where the market was oversold, when it corrected, when the news was too bad, investor sentiment became too bearish. What we're looking at in the way that we're positioning ourselves is, if that happens, that's when we want to take exposure. This is 2008. There were 2 periods in there where you could invest and make a 8 to 10% return. 3 times this year we've done that. 3 times we've gone in, taken exposure, built it up quickly in tranches, ridden the market higher, and come out again. Sometimes that's lasted for 3 to 4 weeks. Sometimes we've done it on 4 or 5 days. Every time that we've done those trades, we've come out, we've realized the profit, and we've added money into our client portfolios. That's how we think that we would rather be owning global markets in 2020, rather than just sitting there and hoping that the market continues to go up after a 10-year market rally and a 10-year economic expansion. It's not going to be, as Jeff said, we don't think we're going to have a recession. We don't think we're going to have a 2008 graph at the end of 2020. But we think that there are going to be periods where it's going to be more attractive to own equities and periods where it will be less. And right now we're in a period where it's less attractive. And this was one of the points in terms of range-bound equity markets. This was this year, mid-April to the end of August. And this was the number of times that we just crossed the 2,900 level in the S&P. By owning equities over that period of 4.5 months, you've contributed very little from a return perspective, but you've imported all of the volatility into your portfolio. We didn't own equities in that period. We owned for 2 to 3 weeks and picked up a positive performance, more performance than we would have got from just holding it through the whole period. So trade tensions, a lot of people talk about US versus China. The bar on the right-hand side is the most interesting one for me, is the share of China GDP exports to the US, 4%. This is why we think that China can be more patient. This is why China has the ability to assess the situation over the course of 2020. They can look at Trump and think, do we want to do a deal with Trump, or do we want to do a deal with his successor? They, in some weird way, maybe it's more China than Russia this time around, have more of a power and a handle in the US election. because Trump, I think, needs a deal in order to be able to get re-elected. China is going to be able to stand there and say, okay, well, we can wait. There's no point for Trump to try and get a deal in November because he'll be out of time. Therefore, he needs to look a little earlier in the year. He wants to be able to announce a deal and then market on the back of that for his re-election campaign. China, with I think it's 3.6% of its GDP is from exports to the US, has the ability to sit there and watch and wait, amp up the pressure on Trump, and then decide how it wants to act, rather than having to follow Trump, because they can take pain. China is not looking at the next 5 months, not looking at re-election in November. They're looking at how do we continue to grow. This is kind of feeding into our thematic ideas of looking at the emerging market consumer, and it's not with a 12-month time frame, it's with a 5 to 10 year or plus time frame. These I'm going to just skip through very quickly. The sentiment aspect is a contrarian indicator for us. So we're looking at the market being overbought. That's a time when we would also be not wanting to own equities, which is just sort of essentially confirming how we're currently positioned from our perspective. Before I hand back to Max, just to talk, or hand to Max to talk about some of the thematic stocks that we're owning and why. Climate concerns. The quarterly that you have looks a little bit at this concept of water and water scarcity. The previous quarterly that we released was looking at the concept of food. We've got a lot of challenges facing us in the years to come. And this comes back to long-term investing. We're not trying to construct portfolios and opportunities that are going to make money over the next 6 months. We want them that are going to make money over the next 6 years or 16 years. One of the big issues that we face as a planet is there are going to be more people on the planet over the next 20 to 30 years, more people that have more disposable income. A lot more of those people, especially in emerging markets, are now switching to a more meat-based diet. You can see on the right-hand side, the lines trending up in Brazil and China in terms of annual consumption of meat. That is only going to continue over the next 5 to 10 years. So one of the challenges that we face as a planet is how do we, with the fixed amount of ground that we have, try and grow more crops so that we can feed more animals, so that we can produce more meat, so that people can eat more meat, and not just people eating more meat, more people eating more meat. This is a huge issue that's kind of slowly coming towards us because we have got a fixed amount of space. There is alternative ways that are now starting to be developed. You know, Beyond Meat has been one interesting example of that. So what we're trying to do with some of these thematic concepts is look at these huge issues that we are going to face over the next 10 years, because they're the ones where the real money is going to be made. Then we're looking at how can we invest in this? Sometimes it's a public company, sometimes it might be a private company. But food is a huge issue and will continue to be for many, many years. And one of our responsibilities, everybody's responsibility, is to try and make sure that we are all able to eat enough food. And if we can make a lot of money while ensuring that happens, then so much the better. I'm going to pass across to Max just to talk you through a little bit on the thematic stuff. This is some of the thematic ideas that we're looking at. Because some of them are big, broad, like the food and water, we have some that are much more tangible. So one of the big ones from our perspective is the emerging market consumer. But when we're starting to look at the video games, online life, and we start to realize that so many of them merge together. And one of the fun things from our perspective is trying to identify not just the thematic concept, the subsector, and then the stocks that fit in that and how fast they're going to grow. But when we find stocks that fit across multiple thematic ideas, that they have multiple catalysts that we think are really going to push them forward over the next 5 to 10 years, they're the ones that we really like.
Thank you, Simon. So as he just explained, in terms of food and water, these are the thematic ideas that we are looking to be more active into the future. And these 4 themes are currently our core thematic ideas that we have been active in already. And these charts demonstrate to you performance year to date of respective basket of stocks inside every thematic idea relative to the indices. And we explain methodology in detail in our quarterly report, but for the benefit of the time, I will say that the essence or the main idea is that when we look into stocks, we try to remove those that are expensive, not growing, unprofitable, and illiquid. And as you can see here, has been a successful method to do so. Let me begin first with defensive value thematic idea. We owned 2 stocks within this idea and gained 10% on each one. And so those are European autos. So back in July, when we looked at European autos, we saw that the whole sector was under great pressure due to multiple concerns around weakening European economy, transition to electric vehicles, slowing demand from China, diesel scandals, and so on. And what it has done is that it pushed valuations to very low levels. But actually, if you look closer at European autos, they are not only cheap, but also more profitable than other global automakers. So on the right-hand side, you can see the two charts. So green ones are European autos, blue ones are global manufacturers. And as I just said, they are cheaper and more profitable. And within European autos, we identified Peugeot and Volkswagen as the best options. Why? Because of efficiency. So Peugeot is the most efficient European automaker. On the left-hand side, you can see the chart where in 2013, they began with annual operating loss of 1 billion euros. Within 5 years, they reached 3.6 billion. The way they did it is they cut costs, SG&A. There was a positive contribution from product mix and pricing. And also, last year, Peugeot acquired Opel Vauxhall from GM and turned around the company so that it reached profitability within just 1 year. Before that, it was unprofitable for 10 or even more years under the ownership of GM. And with Volkswagen, the story is more or less the same, although it's not as impressive, but still they had quite a good performance in terms of revenue and operating margin expansion. The company announced more cost cutting and also increased shareholder focus. And so this way we gained, as I said, 10% in every stock within the first 2 and 3 months. Now the next thematic idea that we still own and we still find it attractive. So we'll continue to keep holding the stocks in our portfolios in the next year. So this is video games. The whole market today stands at around 150 billion US dollars. And within a few years is expected to reach almost 200. That's showing an annual growth of 9%. And within video games, we have identified EA and Tencent as the most attractive stocks. So let me go into detail with EA first. So 2 key drivers for Electronic Arts are sports titles and Apex Legends. Within sports titles, FIFA is the largest video game in the portfolio, and it's a very robust title showing double digits growth both in revenue terms and engagement every year. Why? Because it basically has no competition. The closest peer, which is Pro Evolution Soccer, sells 40 times less copies than FIFA. And the underlying reason for that is because FIFA has almost complete ownership of intellectual property and agreements and licenses with respective leagues, players, clubs, and so on. So if you look at 7 national leagues, the only 2 that are not fully licensed by them is Brazil. They have 15 out of 20 clubs. And in Italy, Juventus missing as a club. However, they still have access to individual players. So when you select this club, you play with Ronaldo and other players. It's just the club is not named Juventus. That's the only difference. And with PES, as you can see, they only have Italy and France. Now, the second driver is Apex Legends. And it's a competitor to Fortnite. You've probably heard about this game. It was a huge success when it was released last year. Within the first month, it gained 1 million registered users. Today, it stands at around 250 million. Whereas if you look at Apex Legends, within the first month, it gained 50 million, so 50 times more than Fortnite. This title is well on track to reach guidance provided by EA for the full year, which is around from 300 million USD to 400 million USD. And every quarter that EA reports earnings, they show very strong numbers. Now, the second company is Tencent. This company is falls not only under our video games thematic idea, but also online life and emerging markets consumer. And Tencent is basically an internet giant within China. And the main asset in Tencent's portfolio is WeChat. WeChat has more than 1.1 billion monthly active users. And also Tencent owns the largest entertainment portfolio in China. So if you look on the left chart, it shows that they have vertically integrated across gaming, video, music, live streaming, and literature. And if we think about in terms of traffic, so Tencent dominates in PC games, mobile games, music. It's also present in long videos, online literature, and live streaming. And another key driver for Tencent, it's not on this particular graph, but it's still a very important segment for Tencent. It's fintech and business services. So this is basically payments. They already have WeChat Pay, which is one of the leading payment systems in China. And what they're trying to do is expand the service to businesses as well. So we still see a huge opportunity in the stock, despite the fact that it was under pressure, as all other Chinese stocks due to the trade war concerns. But nevertheless, we keep both Tencent and EA in our portfolios. Another stock that we bought a couple of weeks ago is called Mail.ru Group. And it's to some extent equivalent of Tencent in Russia. So it is also an internet giant. It initially began as an email service. Today it has presence across almost all consumer internet verticals, apart from online video. But they are leading in all other segments. And for them, two most important ones in terms of revenue and profits are games, which are primarily casual games and online games. And second is social networks. So they own VK, which is the largest social network platform in Russia and CIS region. And also crucially, they have a key partnership with Alibaba for their e-commerce platform. The next idea, which falls under our online life and emerging markets consumer theme, is Trip.com. Trip.com is an online travel agency. It's #1 in China, has a market share of 52%. They have a vast portfolio of hotels, approximately 1.4 million. Also airlines, 300 airlines. And they provide, it's a key play on growing Chinese tourism. So on the left chart, what you can see is a China online travel market, which in 2018 stood at around 1.5 trillion yuan. It is forecasted to grow in double digits, and it is still a relatively low penetrated market in terms of online, approximately 35%. And if we compare China to other countries on a per capita basis, there's a huge opportunity there. So only like 1 in 10 people travel outside China, and they, in terms of spend, is also behind developed markets and countries. And yes, sorry, I forgot to mention as well that Trip.com is now focusing on international markets. It has a target to become the global leader by 2025. And this is one of the reasons they changed, the key reason why they changed their name from Ctrip, which stood for China Trip, to Trip.com to be more international. And last but not least, another investment idea which falls under our video games theme, Ubisoft. Ubisoft is a French company. It's one of the major global video games publisher. It has a solid portfolio of AAA titles, which it expanded significantly. So for example, in the table, you can see that in 2011, they had only one major title. In 2019, they have a vast number of them. And let me tell you a brief background about Ubisoft. So the company released, they cut guidance at the end of October. And the key reason for that was that one of the major titles they released earlier did not perform as well as expected. And also the company announced that they will postpone 2 games by 1 year. So the stock plummeted 30%. However, it quickly recovered just in a couple of days. And then actually a few days later, they reported Q3 numbers, which were ahead of expectations. And this showed that other titles were performing strongly, as well as back catalog. Back catalog means basically that gamers are spending money inside older games. And we see this as an attractive opportunity. Also, in terms of valuation, if you compare it to major peers, it stands on a forward basis, looks very attractive. However, profitability is, you can say, superior to global peers as well. And another potential catalyst for them is mobile in China. So they currently have one video game that is being reviewed by Chinese government. And when the decision will be announced, and if it is positive, this will be a huge catalyst for the company. Thank you.
Thank you. The collection of individual stocks that we've talked you through at a very, very top line level is kind of a reflection of how we're looking at the world. And you end up with some American, European, Russian, sort of some coming from Asia. So it really is a global portfolio. We're trying to build up these individual opportunities. When we were looking at the video games, and one of the hardest decisions to make from an analytical perspective is how do you come up with the stocks that you want to own? Because there are thousands of companies out there. And how do you decide which one of those companies that you want to dig into? Because we're not investing into anything until we've fundamentally gone through it and looked at every different aspect of the business. And it's not possible. You can't hire enough people to do that for every single stock. So you have to end up trying to screen out ones that you don't want to invest into. So when we're looking at video games as one example, so you screen out all of the companies that aren't involved in video game manufacture. That's a nice, easy one to do. Then you're kind of looking at the next steps in terms of what is it about video games that we want to get exposure to. When we did a focus talk on video games, and it was Max that was saying that the gender split on video gaming is 50-50. There are essentially as many women playing video games as there are men. Very different ways of playing video games, very different types of games and sort of gaming environments. And a lot of women wouldn't consider themselves video gamers, but would then spend a load of time playing Candy Crush on the phone on the way home, which counts as video gaming. So then we're starting to look at how do you monetize that? Where is the growth in expenditure? Because where consumers are spending, companies are making money. So then we started to look at, well, which regions are dominating from not just the current revenue, because we're looking in the future, but future revenue growth. And this is when we started coming back to emerging market consumer. The Asian consumer was more engaged with games, spending more money on games and growing faster. So we started then screening not just for stocks that were in video games, stocks that had more mobile applications from a gaming perspective, which is much more popular. Then starting to put on additional screens in terms of what percentage of the revenue comes from Asia. How fast is that Asian revenue base growing from a revenue perspective? And then we start to put on additional filters, which helps us get to the companies before we start digging in. And it can be really frustrating when you're digging through a company, you get to the end and realize it's not one that we're going to own. But all of these companies have gone through the screening process and then the fundamental analysis process. And it's trying to do this hybrid approach of utilizing the quantitative tools. We put up the bond screening tool that we have. This is something that's available internally that we're trying to get it out for our clients to sort of empower the clients so you can see how bonds are being priced. But what we're trying to look at is combining this fundamental analysis with the quantitative screening to enable us to have better performing stocks and better performing portfolios. Thank you for coming.